Hi everyone, Mike Riley here with Gaining Altitude Financial, and today I've got an interesting case study on the differences and benefits between mortgage insurance that's provided by the lender at the time that you apply for a mortgage and personal insurance that is purchased usually through an advisor like me that is then owned by the owner and the insured, which they can carry on. So I've said this before in previous videos and posts that there are huge differences between them, and the one I'm going to look at today is one that was provided for a client, a single dad who recently bought a condo and was offered the insurance protection by the mortgage broker, which they're obligated to do and is a good thing for them, even though I don't think it's the best product, but it is certainly better than having nothing. But in this case, there are four main differences for why a person would choose to have personal insurance versus what's being offered by the lender. And for most people, the number one thing is cost. So for this individual, it's a 30-year-old male, non-smoker, and was offered, so the mortgage is $382,000, and the cost for the monthly premium for the mortgage through the lender's insurance was $32 a month. Now that's not going to break the bank, but if you're like most people, you certainly do watch every dollar, and if you can save money someplace, then that's what you would do. The same amount of insurance through one of the providers that I use, so $382,000 on the personal side, was only $19 a month. So that's a significant savings for the life insurance. The second reason why I would recommend that people look at having their own insurance rather than taking the insurance offered by the lender is what happens with the balance. So if this client had taken that insurance, over time, I would expect that they would be paying the mortgage down. So there would be less of a liability. And in the event that the client died, say, 3 years from now, there would be less than $382,000 that would be owing. So the balance of what you would pay for, what gets paid out goes down. But the cost doesn't change. So you're still paying the same amount of premium for less and less insurance all the time. Whereas with the personal side, that death benefit remains level throughout the period of the insurance, and the full amount gets paid out if that individual dies. The third, and this one is one of the reasons why I think it's important to have this conversation, is who is the beneficiary. So on the mortgage side, if the owner of the insurance, if the insured person dies, then the beneficiary is the lender. So let's say it was TD. They would receive the death benefit, but not the family. So declining balance paid to the lender to cancel the mortgage, which is not a bad thing. But in many cases, I find that the people that I work with would rather have the money in their own hands and decide what to do with it. Maybe reduce the mortgage by a certain percentage, but then have some money for other uses, because when someone in the family dies, it does have a big impact. So on the personal side, you can determine a beneficiary that you want to have to receive the money. And finally, the fourth reason why I would recommend that you look at having personal insurance is, what is the proper amount? So the amount covered by the mortgage insurance is exactly the amount of the mortgage, whether it's on day one or day 300 or 700 and something. But in talking with people, I often find that in addition to paying off the mortgage upon death, they would like to have other things taken care of as well. So maybe there's other outstanding loans like credit cards, student loans, vehicle loans. They would like to have things like ongoing income replacement. So even though the mortgage or a portion of it's paid off, Maybe there's an additional $50,000 that needs to come into the home on an annual basis for food and utilities and gas and clothing. In this case, the single dad is planning on contributing to a registered education savings plan for his child. Upon death, that's no longer possible because he's not bringing in an income. So we can take a portion of the life insurance benefit and fund an education fund. And of course, as I said, there's a single dad, but he's dating, and it might be another person in his life at some point, and we had to account for, well, would you like that person to receive some money? What would it take if you combined your households? So when we did that, the amount here, as I said, is the $382,000, but he was looking at $500,000, and the amount for $500,000 was going to be $22 a month. And I said, well, what does it look like 2 or 3 years from now? Do you think you could need more or less? And he said, well, I'll probably need more. So $750,000 of life insurance now was only $31 a month. So at the end of the day, based on all 4 of those factors, the client went with a term 10 $750,000 policy for $31 a month, which was just a little bit less than what was offered by the lender, but a significantly more than twice the amount of life insurance, and it was the right amount that he needed with the right product. So if you are looking at mortgage insurance, or if you have it right now, I encourage you to consider taking a look at what owning your own insurance outside of that or replacing it would look like. Does it cost you less money? Is it a balance that you can count on when the beneficiary receives it? Is it a beneficiary that you would like? And is it the right amount? So all 4 of those factors should be considered. If you'd like to know a little bit more, please reach out to me. Always happy to help. So Mike Riley of Gaining Altitude Financial, helping you gain altitude and gain confidence.